Well, good morning, everybody. Welcome to the 17th Asia Investor Conference. They tell me there are more people, more meetings, and more fantastic keynote speeches than ever. So welcome. I'm sure it'll be a very intense week. It's now slightly traditional for me to kick this off. And I thought I'd choose for the title something to put a slight dampener on the optimism that we've seen develop over the last year or so, because a lot of people have, in the last few months, have been debating this particular point. Are we at the end of the equity bull market that we haven't so much enjoyed as managed to live through over the last 5 years? And there are a variety of reasons for concern. One is that in my working lifetime, which stretches back over 35 years, I know there weren't laws against child labor in those days, but in my lifetime we've had 3 significant bull markets in global equities. Each one of them has lasted 5 years to the month. We bottomed 5 years and a week ago. So that's one reason for thinking about this question. The more sort of profound reasons have to do with the fact that as the US economy in particular starts to show more signs of genuine recovery from the financial crisis, a lot of people feel that the gains that we've seen in equity markets in particular have been fueled almost entirely by central bank expansion of their balance sheets, QE, and so on. If this is the end of QE, is this the end of the bull market? There are a few other things that people cite as areas of concern. There's Russia, there's China, there's always the possibility of external shocks. Some people are quite bearish about what happens to inflation in the US if the economy continues to recover. So there's actually quite a variety of reasons why people are concerned right now. And what I want to do is to give you my take on this question, which is very simply that, and this is maybe a hostage to fortune, I don't think this equity bull market is over, and I don't think it's over by any means. But we're going to go into a slightly different phase. And I'm going to try and think about possible scenarios for that phase. It does seem to me that if profits grow, if bond yields stay low, if the equity risk premium, if anything, comes down as people get more confidence in the sustainability of recovery, that's where you get more potential for the equity market to extend from here. I go on to say that there's no sign, you could even argue that in emerging markets, the bull market hasn't even started, which is an interesting question we'll maybe get into later. But before I actually go into the body of the presentation, I should just mention one thing to some of you who may be the more observant, is that I'm not here any longer as Chief Global Strategist for the Investment Bank. I've actually changed allegiances and joined our asset management division, where I'll be running a new unit called Systematic Allocation Strategies. We already have several $100 million that we're managing and have been for 4 years, and we will be developing a variety of potential solutions based around my sort of macroeconomic framework and systematic ways of implementing that in asset timing and so forth. So for those of you who think that I'm talking my book, let me just say that central to that new role will be me continuing to do what I've done for the last 35 years, think about the state of the world economy, and think about all the things that might happen, as well as the things that I think are going to happen. And that's what I want to share with you today. So let me just show you, to begin with, one of the possible reasons for concern. Here's a chart of 3 different bull markets in MSCI World, admittedly, mostly that's the developed markets. You can see that this particular bull market is now tracking almost, uncannily close to 2 of the previous 3. The one that began in October 2002 and ended so badly eventually. The one that began in March 95 and ended in the tech bubble. And also the one which began in August 1982, coming out of a very deep recession. And if you follow that particular metric, we were within a month or so of the or a few weeks or so of the 1987 crash. But you can see that that bull market was much, much more intense, and particularly in the period running up to the crash, and bond yields had gone up very, very, very fast and were very high in real terms. In any case, that's one perspective. It shows you what's happened in my working lifetime. There have been other bull markets, but not really proper ones. If you want to take a slightly different way of looking at this, then this is taking MSCI World and asking, well, when did the bull market really end? Bear market, I should say, really end? Well, you could argue perhaps it didn't really end until 2012, in which case even on the 5-year rule, you've got a bit more time to go. You could argue that perhaps the European crisis, the record panic low in risk appetite in 2011 was more of a starting point for this bull market than the actual absolute low post-Lehman's. In any case, if you applied this same sort of metric to MSCI EM, looking at just emerging markets, you wouldn't even have broken out yet. So the paradox about this particular speech, or one of the paradoxes, is that as far as emerging markets are concerned, there hasn't been a bull market over the last year or so. And although the economies in the emerging world have in most cases recovered most of the losses that they suffered in the great financial crisis and gone on to see output and activity make new highs, the equity markets haven't, and have actually underperformed quite badly, quite dramatically, in fact, particularly since the Fed's tapering. If we look, however, at sort of a longer perspective on bull markets of the past, using one of my favorite charts that was particularly useful at the height of the tech bubble, looking at real equity returns in the US going back all the way to 1850, thinking about the long-term trend and the deviations from trend, you can see that in that particular sequence there are a number of secular bull markets and a number of secular bear markets. On the whole, the secular bear markets tend to be of the 12, 13, sort of 10 to 12, 13, 14-year variety. And there have been a few secular bull markets that have been 18 to 20 years, to 22 years or so, and a few that have been rather shorter than that, more like 10 years or so. What I want to really just draw your attention to is that we started this bull market, unlike 2002, unlike 1995, but more in line with 1982, at a very depressed level relative to trend, and on most metrics at that time, stocks were at least, they were cheap against bonds and they were cheap in absolute terms. Where we've got to is around about a quarter to just above a quarter of a standard deviation above trend. One standard deviation in logs is about 34%. So we're not very far above trend. Now, there's no particular reason why we should think and extrapolate this trend forever. It's a useful rule of thumb. But what we can see is that there is almost no period, or there are very, very few periods, in which the equity market stays close to the central trend line. It's usually in motion from being very cheap, being way below trend, to being above trend. People ask me what would it take for this to count as a proper bubble? Well, using this very simple metric, you need to be at least one standard deviation, more like 1.25 to 1.5 standard deviations above trend. Now, I can see you doing some mental arithmetic there. If you were to say, well, what does it take for us to get to, say, 1.25 standard deviations above trend? You'd have some years of 6% per annum real returns plus another 35% or so. So maybe we should take a look at some of the some other precedents. Here are 3 other ones. I notice that there's a slight error on the on the bottom one. It shouldn't say July 1892. It should say July 1982. And here you can see, you can see the stock market crash there in that top pale blue line in '87. But you can see even with that, the bull market continued for quite a lot longer. And you can see that a couple of the other examples I've given, November 1948, and of course the low point after the First World War, which led eventually to the 1929 bubble and crash. You can see that if you start cheap, that is to say, if you start a long way below trend on our previous chart, there's a lot more upside. You could easily, on this chart, if you were to follow the same path that these examples show you, you could easily, in 2 to 3 years' time, see that index of real return some 40 to 50% higher than we are today. Now, interestingly, on these particular comparisons, if you were to look at the next sort of 6 to 12 months, doesn't look all that exciting. And what I want to do is to move from simple sort of thinking about historical comparisons just to emphasize that at the end of the day, even when you're going into a bubble or to an overshoot of valuation, it's always the fundamentals in some form or another that drive these things. So I think rather than try to think immediately about all the concerns that we have and that we sort of discussed and that I referred to earlier, I want to just paint a little picture of how I think the world might evolve over the next few years. And to me, what really, really counts about whether this equity bull market will continue is, above all, whether the central banks and the fiscal authorities and the governments of the developed world actually manage to complete the job of repairing their economies post the financial crisis. What really matters is whether we actually manage what I call round 2. Round 2 is reflation. Round 1 was saving the world from collapse. Reflation for me is a state of the economy in which nominal and real GDP accelerates and begins to converge back towards something like trend, and we can debate what trend really is these days, but at the same time, short and long-term interest rates stay relatively low and below that path for nominal GDP growth. That means that cash flows in the economy are growing faster than the level of interest rates. It's a subsidy. It's a blatant subsidy to borrowers. In a very highly leveraged economy with lots of debt, that's part of the long-term solution. But what if the bond market revolts? In my opinion, from here, whether this and how well this equity bull market does depends as much on the bond market as it does on the economy and profits. We need, for reflation to really work, we need to keep long and short-term interest rates low for long enough to get the economy back towards full employment. If, on the other hand, bond yields normalize before the economy does, that to me is a much, much more bearish kind of outcome. And I think that the paradox in all that, or one of them, is that the stronger the US economy is, the harder it will be for the Federal Reserve to actually keep control of the bond market. I'm not myself completely convinced that they will be able to deal with an economy which accelerates from, say, 2.5%, 3% to maybe 3.5% to 4% in terms of GDP. That's not a very common forecast for the second half of this year, but it's a possibility. And I think the framework for policy that Ms. Yellen set out just recently will deal quite adequately with an economy that's growing just very slightly above trend and help to keep the bond market relatively well controlled. But I'm not so sure that it will be able to deal with a truly strong economy. So oddly enough, we spent most of the last 5 years worrying about too little growth. We're still worried about what might be happening in China and in the emerging markets in response to even the little bit of tightening of policy that we've seen. But from here, what really matters is that the task of reflation is more complicated if we get really genuinely strong growth. So I want to reflect on that and some of the things that that may bring with it. And I'm going to suggest to you that there are at least two scenarios which I can see for the next year or two. One of them is that we actually spend quite a lot of time in the course of the rest of this year struggling with this trade-off between growth and inflation, growth and interest rates, and we don't make much progress. And then as it becomes clearer that it's going to be possible to pull off this trick of reflation, we do extremely well. My preferred scenario, however, goes back to a chart that I've used, I think, a couple of times here in the last couple of years. For me, the sort of model for this crisis and its aftermath, if there is a model, is the 1890s, a couple of banking panics followed by a kind of difficult base building of recovery, and then 7 years or so of reflation of exactly the type I've just described, in which nominal GDP and profits accelerated, but bond yields actually didn't go up very much. And you can see here that on that sort of metric, it fitted extremely well during the crisis period. This would have been, I think, almost identical had we had a real European crisis. And now you can see that we've sort of started to move into what I would call the proper reflation period. If we were to have a period in which the economy does well, but not so fantastically well, the bond market stays well behaved, profits continue to grow, it's possible that we'll get another somewhere between 10, 15, perhaps % more in terms of the US equity market, and then move into a period in which the Fed begins to tighten and we actually lose most of it. That could be that's a very feasible scenario for this year, and I'll sort of think about that a little bit more as I go forward. But first, I want to just talk about the 5 themes which for me are a way of trying to sum up what I feel about the next few years, some of the themes that will dominate the global economy, not just the US economy. And while I think reflation is the central issue and the success or otherwise of central banks in completing the recovery process, and particularly the US central bank, which is really de facto also the central bank for the APAC region, there are a few other things. One of them is that almost by implication, but certainly it's been part of my view for a while, that we've moved from the crisis period in which equity market behavior, risk on and risk off, and equity market behavior was extremely correlated. It was extremely difficult to be an effective stock picker. We've moved, I think, to a period in which there is lower systemic risk. Now that begs the question about what happens in, what might happen with Ukraine and Russia. It begs the question about what could be happening in China. Personally on China, and I'll say maybe a little bit more about this later, and I can certainly respond to questions at the end. On China, I think there is a very important historic process that's just sort of got underway. In some ways, it's what I would call the big cleanup after the last boom. This has been done before. We've had 2 booms and we've had 2 cleanups previously. A cleanup of bad loans, excess capacity, corruption, even pollution, you could say. But I think there's also an attempt to reform in a more profound way, to change the incentive structures which drive growth in the Chinese economy in the future. Less government, more markets is a very shorthand way of putting that. If that reform is ultimately successful, and there are a number of very difficult stages for it to go through, then I think it will be extremely bullish for the quality and sustainability of Chinese growth. And we will see a very different kind of Chinese economy and Chinese growth emerging from that. And that may actually be far more bullish for the financial markets within China, for the equity market, for example. Not so bullish for property in the short run. And in some ways, changes the impact that China will have on the rest of the world economy. Soaking up fewer resources or not soaking them up at such a great rate. That actually could, for some parts of the developed world, actually be rather bullish. Not so much for the commodity producers, but more for the commodity consumers. Could actually help to keep inflation low during the reflation period in the West and so forth. So I wouldn't want to minimize some of the difficulties and how much slower Chinese growth could be for a while as the big cleanup continues. And I know Dong Tao is going to be speaking, and at various events this week, and I think he has some very interesting things to say about that. But in the longer term scheme of things, I actually feel more encouraged by what I see coming out of China than discouraged, albeit that I think the next few months could be quite difficult. So let me say that as far as I can see, we have moved into a period in which there isn't the same degree of systemic risk that we've had to deal with, particularly in the last 2-3 years with the European sovereign debt crisis. That gives a lot more room for the stock picker, for active management, to actually outperform. And we've seen that already in the last year or so. If we have a bond market revolt on a big scale, don't worry. the correlations will come back to one again. But I think the question for me is, well, if you're in that sort of world, what kinds of stocks? How will that change, and so on? I'll come up with some suggestions on that in a minute. The other thing that I think is extremely important in thinking about the future is that there are a number of areas of technological change which I think we just begin to see are gathering steam and which could provide new investment opportunities and will throw up companies with very rapid earnings growth, but also be very disruptive to incumbents. The ones I think of, just as a shorthand, are energy, where it's where it's both shale and alternative energy and some of those kinds of issues. What I call for shorthand robots, which is smart machines, which are increasingly beginning to develop a capacity to replace human labor of a more skilled sort than we've seen up till now. And the whole social media, digital lifestyle story, which in my opinion could end up having some very unlooked for and unforeseen consequences, whether that be in the financial industry or in sort of marketing and the whole way in which new businesses grow, develop, and die. One thing that I think is going to be playing alongside that is the story I've already sort of mentioned about China, which is really a question of reform. For the emerging markets to realize their full potential in terms of growth and in terms of asset returns, many, if not most, of the leading emerging economies have to go through a period of structural reform to create the foundations for better growth in the future. Some of them are doing it, and most of the markets that are doing it, Mexico, for example, is a good example. Most of those markets on most valuation screens look expensive relative to the ones that are not. It's almost as though investors are amazingly focused on the foundations of longer-term growth, profits, sustainability of growth, quality of governance, and so on in the emerging markets. And I think that's going to be a theme that continues for a long time. I think consistent with the slower growth path for China, we're in an era where it's relative value in commodities that matters. Some commodities will do better than others. The supply situation will differ from one commodity to the other. And there won't be the same huge excess demand for a whole variety of commodity products going forward. And in particular, and I may have a chance to say something a little bit more detailed about this later, in fact I almost certainly will, I think that the outlook for energy and oil prices is flat to down for an extended period of time. Maybe for a couple of decades, who knows. Now that's not fashionable either. But if it's right, and particularly if it's right over the next year or two, this will make the task of reflation, my top agenda, much, much more possible, and so on. It will also create circumstances, if oil prices were to move somewhat down rather than up, those are circumstances in which margins actually often expand, because initially firms who are energy users do not pass on the full benefit of their lower energy and input costs. And finally, boomers are retiring. There are all sorts of bad things that come with that, but there are some good things too. And I'm still a great believer in the great surge in the emerging market middle class and their consumption patterns. But if I had to sum up how it looks for the developed world versus the emerging world, I would say that what's happening, particularly in the US economy now, and particularly on the technology front, makes me think a little bit about, I think it was Alan Greenspan who coined the term, the weightless economy. This is the idea that the sources of growth in GDP and profits and so on, and in real income and productivity in the developed world are increasingly focused and driven by technology, knowledge-based work, and so on. It doesn't require very much investment in large-scale physical capital infrastructure, structures, and so on, to produce the same amount of growth in GDP and welfare that you needed before. This is, if you like, the post-industrial society. It has a number of consequences. It means, for example, that we have less and less of a good handle on exactly what's happening to growth and inflation in large parts of the economy. We can measure rather well the impact of technology in manufacturing. In fact, if anything, we probably overemphasize the impact that it has on manufacturing productivity. But in the service sector, we're very, very bad at measuring the precise effect of technology on the quality, variety, and volume of output. Be that as it may, for those of you who want a sort of vision of what a good version of the future for the developed world could look like, you could do worse than read quite an old article now by Lawrence Siegel, not Jeremy Siegel, which is called Fewer, Richer, Greener. And the argument there is that essentially there's no reason to be pessimistic about long-term productivity growth, in which case there probably isn't any reason to be pessimistic about earnings per share growth. And earnings per share growth is what drives long-term wealth accumulation and stock market performance. And that we will be building an economy which is much more efficient in the way that it uses resources, much better for the environment, and there'll be fewer people and less population growth, but that's no reason to think that the world will be a dismal place. Now, there are all sorts of counter-arguments, but I think it's interesting to put that sort of idea forward, because for any bull market to turn into a bubble, which is kind of what I think could happen at the end of this one, there has to be some vehicle for fantasy. And I think that we can begin to see in energy, robots, and the digital lifestyle where some of the fantasy is going to be. Or to put it more technically, those companies which can deliver sustained above average earnings growth, above average level of GDP and a low interest rate, perhaps declining equity risk premium environment, could get to have phenomenal valuations. And we see that already happening in the US market to some extent. Meanwhile, as the middle class booms in the emerging markets, that's a phase of industrialization in many ways. That's more like the old-fashioned 19th century industrial revolution. It requires lots of investment in things, new infrastructure, building of factories, building of houses, building of roads, and so on and so forth. So there's a kind of contest, if you like, between, or there's a difference between the sources of growth in the developed world and the potential sources of growth in the emerging world. And if the emerging world is going to go into a somewhat cooler phase, particularly because of the adjustments that are taking place in China, that actually gives us a bit of a breathing room from some of those commodity pressures and so on that have been part of the difficulty that the developed world economies have faced in the last few years. So that's kind of a very, very sketchy sort of overview of the kind of context that I see on a broader level. And it certainly doesn't make me believe that disaster is inevitable. Nor does it make me believe that managing an equity portfolio is going to be that easy. So here are 5 possible solutions at a very high level of abstraction. As you'll see in a moment, the paradox about what I've just said is that in the developed world, particularly in the US, on pure sort of old-fashioned equity metrics, it's very hard to say the US equity market is cheap, and there are some other forms of looking at that besides my simple real equity return thing, which says they really are quite expensive. Schiller PE, for example. Now, what happens, or what is most likely to happen, to US managed money, sensitive to the idea that it's getting harder and harder and harder to find cheap stocks, with lots of inflows coming in after years of drought? What are they going to do? Tour the world in search of value. We've already seen them coming to Europe. They're beginning to look at the more distressed situations in emerging markets. It's usually the case, or often the case, that in the later phase of a stable, relatively stable bull market, where there isn't so much, where there is less systemic risk, instead of putting such a high premium on value, on quality and the kind of stocks that are going to be immune from the worst possible outcome that you can imagine, once we stop imagining all these terrible outcomes, that becomes an era in which the sort of classic value stock investor usually does very well. By definition, from what I think about technology and the rest, I think there are going to be a number of what I would call disruptive clusters of activity. And in those disruptive clusters, the really smart equity fund manager can both pick out companies with very, very above average sort of growth possibilities, and perhaps also those that are going to end up suffering hugely from the disruption. Now, it's a moot point as to whether Tesla should have a higher market cap than GM. But it asks the right question. One of the reasons that I'm bearish about, or somewhat bearish about oil prices, medium to long term, is that after last year, for the first time in my entire career, I really believe that the US economy is going to gradually move off oil as its sole transportation fuel. The Tesla Model S has made electric cars cool. The proposed battery factory and the new cheaper model may make electric cars relatively affordable and more competitive. At the moment, it would take about sort of 7 to 9 years to pay back the extra cost of buying an electric car versus buying a conventional car. But in my opinion, the combination of cheap shale gas to provide the cleanish electricity to drive electric cars, the superior sort of technology of electric cars in terms of acceleration and torque. If you can get round the sort of distribution and the refueling issues, and I think we're sort of beginning to move into that area, then I think electric cars become a really viable option for the United States. So when I say disruptive clusters, I haven't a clue how long this is going to take. It could take a very long time. If you're sober about it, you think it's going to take a very long time. But if I think about out 25 to 30 years, I can imagine a circumstance in which a combination of the shift to electric cars, to biofuels, and to LPG as a fuel source, maybe for heavy trucks and so on. It is possible to imagine that the US will be importing maybe, or consuming, I should say, 25 or 30% less oil and petroleum products than it is now. That would be a completely new world. That has enormous geopolitical implications, potentially. It has enormous different implications for countries, and it has enormous different implications for individual companies as well. So that's what I mean in more general terms about disruptive clusters. There are a number of those. If bond yields and the equity risk premium stay low, sadly, we are destined to have a bubble in the kind of stocks that are going to lead that disruption. Sadly, or not, whatever you choose. In any case, I think that's another theme that will last for a few years, maybe for a decade or so. I think there will be, through the process of reform and through the process of the exit of liquidity from the emerging markets, be episodic opportunities arising. I suspect the disruptive clusters and reflation theme means that technology in general will outperform EM. There are these cycles that we have where EM is the source of growth and optimism, and then there's technology that's the source of growth and optimism. And in each case, at the end of it, either EM or technology gets very overvalued. But I think that's likely. The other thing that I think we need to take away from my 5 themes is it's time for the equity investor to become a bond geek. Since it's going to be the discount rate, the main threat, if you like, to my more optimistic scenario is an overshoot of bond yields. It won't do you any harm to get into the weeds of what drives Federal Reserve policy, what drives the bond market, what the equilibrium funds rate is supposed to be, how quickly you're supposed to converge, and so on. So becoming a bond geek would do you no harm whatsoever. And the other thing that I think this implies is that there is going to be a challenge which most equity fund managers will find it very difficult to rise to. If, for example, we have this scenario where growth in the United States accelerates very strongly. Let me give you a sort of an idea about how that might come about. What happens if, for example, this year, the American rapprochement with Iran goes quite a lot further? The Iranians come back and become big suppliers or have another 500,000 barrels per day of production, which is freely exportable, and so on and so forth. Libya, output comes up from the depths. There's another 1 million barrels per day coming out of shale oil production in the United States. The economy otherwise is growing relatively slowly. It's actually slowing in terms of momentum coming into sort of May, June before. And you end up with a situation that's a milder version of 1985 when the Saudis had to pull the plug on the rest of OPEC and produce, and we had this collapse in oil prices followed by a surge in activity later. This year already, we're seeing that fiscal policy will be less restrictive in Europe, in the United States, less of a drag on recovery. The way I think about oil prices, particularly for the US, it's just like having a tax cut. If we were to have a further layer of lower oil prices, that's the sort of scenario in which you could potentially see growth accelerating in the US beyond the sort of 2.5 plus or minus growth path that it's been on for a while. But that's also the circumstances in which real bond yields are most likely to go up. Now, were that to happen, the kind of thing that you might see at the beginning is that the impact on headline inflation would help the Fed to react very slowly to any pickup in activity. Profits would do extremely well. So would the equity market. But what if the economy is really strong and stays that way for a while? And you start to see measures of wage inflation and core inflation also picking up and so on. You can begin to see that what benefits you greatly at the beginning could bite you a little bit later on. And it's that sort of kind of oscillation between growth being positive, profits continuing to grow, and what's happening in the bond market, which I think we need to keep an eye on. And it's an environment in which asset timing may become important. We may see the first euphoria for 7 years in our risk appetite index. And the right thing might be to be tactically completely out of equities and in bonds for 6 months or 9 months. If you go back to the reflation chart that I talked about from the 1890s, where we went up and then we basically lost it all, that's an envisageable scenario. It's a bit too early to say it's a forecast, because, but it's the kind of thing that I think we may have to cope with in the environment going forward. So those are my sort of proposition about things for equity fund managers to think about in the kind of fundamental environment that I see going forward. And I'm sure that some of those things will resonate with you as you go through all the different meetings and keynote speeches, etc., that we've got lined up for you in the rest of the week. So let me just say a few things to end up, and then we'll leave time for a few questions at the very end, and I'll be relatively quick here. About the 3 types of risk that I normally think about when trying to gauge the longevity of an equity bull market. One is external shocks, where the key ones are China and Russia. I've already said something about China. My view on Russia is that it's extremely difficult to think in detail or to know in detail what's going to happen over in Russia over the next few, and with the Russia-Ukraine issue. There'll be a number of people who address that issue during the course of the conference. But my instinct is this is just another chapter in what I think George Friedman called the Little Cold War. There is no need, and there probably is a low likelihood that Russia is going to move troops into eastern Ukraine anytime soon. In 2 or 3 years' time, they want to make sure that they not only have complete control of the Crimea, but they have a lot of influence about what happens and how Ukraine is governed. It's their traditional buffer zone against the West. They're not going to give that up easily. If you want a very interesting and I think kind of wise kind of analysis of what should be happening with this issue, then look up Henry Kissinger's latest article about that. But the bottom line for me is that I find it unlikely, though not completely impossible, that this is going to turn into a new systemic shock. And that allows me to think about other issues going forward. Policy error. This is where we don't complete the job of reflation for one reason or another. Policy is too tight, we let the bond market get out of control, and so on. I've already alluded to. Regulatory overkill, particularly perhaps in terms of a misguided attempt to sort of rein in the shadow banking system. That's not to be ruled out completely, and that's one of the issues I'll certainly be watching. And the third thing is, are there internal imbalances of valuation, leverage, collateral, etc., which tell me to be very, very frightened indeed, which is what normally is the case, for example, was the case in 2000, was the case in 2006-07 with the US equity market and so on. And taking those in reverse order, the thing that I find most interesting about this bull market is it's the most depressed bull market I've ever come across. This is a chart of our measure of global risk appetite. And you can see it goes up and down sort of within a relatively orderly range most of the time. But we have not had a euphoria for 7 years. We've had 2 ultra-deep panics. We've had 3 in the last decade, which is extremely unusual. And if you look at the 5-year moving average of risk appetite, it's only turning down from, turning up, I should say, from a very depressed level. Now, when in 2006-07, it was up here. What we've found historically is that that 5-year moving average of risk appetite is a very good proxy for leverage in the financial system. This whole period we've been through has been deleveraging the financial system. We have much, much less leverage within the financial system. We're only just slowly deleveraging in other parts of the economy, but much less leverage in the financial system. So, from my point of view, this is rather constructive. It's not clear to me that we've got the same kinds of imbalances as we had before, particularly in 2002, 2000 I should say, or in 2006-07. If I look at what's cheap and what's not using the same simple technique of looking at long-term deviation from trends, I still come up with gold and oil being the expensive things, bonds only slightly expensive now, and then the EB ratio means the equity to bond ratio, and versus where bond yields, all the major equity markets look cheap, and maybe the Japanese equity market looks cheap outright. That's a little bit more controversial. US housing, on the other hand, still looks very cheap. If I worry about valuation, deleveraging, so on, so forth, it's in pockets of EM. It's obviously an issue for parts of China, and so on. If I look at where we are in terms of sort of risk appetite and spirits, this very low level of real bond yields in the United States goes hand in hand with that low level of animal spirits. If I look at Germany and Japan versus the US in terms of the deviation from trend figure that we looked at, there's even more possibility. They're even further below trend. Again, an issue, a place to be looking for value. If I look at Japan on its long-term trend, I wonder whether we are just about to break that sort of downtrend. Maybe if there's time, we'll just have a question or two about that. Finally, I just want to highlight the basic paradox behind this whole story, and that is this. If you look at measures of nominal GDP, but I could have used real GDP, you take a simple trend from 1990, and you look at how far below trend after 5 years of so-called recovery the US, the UK, and the euro area are, they're all a very long way below trend. Even allowing for the idea that trend growth is slower now than it was before, we're at least 5, 6, or 7% below trend for the US, and probably even further below that for the UK and for Germany. Reflation is about making some progress in this direction without having bond yields adjust over quickly. Very simple, very powerful for equities if that happens. If you look at which countries are how advanced they are in economic recovery, one of the reasons that Europe and Japan are cheap is because in kind of industrial production terms, which is often the most direct metric for corporate profits, much less recovery here than there. If the US economy continues to grow and policies are reasonably good in these two countries, you're going to see profits explode in these two areas. They've done their restructuring and so on and so forth. And if they grow, they'll see profits do very well. So here, in the end, is the paradox which I'm most concerned about, and we'll only have a chance for one or two quick questions. But it's this. If you look at a trend for real earnings in the United States as opposed to real equity returns, it's a funny series. It seems to have a structural break around World War I. It has a long-term slope, in both cases, of about 2% per annum, pretty much in line with the growth in output per hour. This is what's happening to profits. It's the only thing in the economy that is way above trend after 5 years of recovery. The economy is, on one metric, 11% below trend on nominal GDP. Even on pessimistic supply assumptions, it's 5 or 6% below trend, and profits are up here. And they're growing. And in fact, forecasts, this is the forecast from the top-down guys for US corporate profits, range from being up 15 to up 20% over the next couple of years. Few equity markets die when corporate profits are growing, and growing in a pretty solid fashion. The discount rate has to go up, or something very unpleasant has to happen to the real economy to really create the conditions for a major and sustained reversal in equity markets. That's the fundamental paradox we're living with. And if we were to look at this chart where you look at the deviation from trend of earnings, which is the gray line, and the blue line, which is the deviation from trend of real equity returns, and if this continues to move up to nearly 2 standard deviations above trend, there's quite a lot of potential for this one to follow. Normally, they're fairly correlated. So ladies and gentlemen, I don't think the equity bull market is over, but just how bumpy it gets probably depends more than anything else on Federal Reserve policy and the bond market reacting to a situation in which profits continue to grow from a very, very high level relative to trend. So, thank you very much indeed for listening. Now, if I'm allowed, I think we have time for 2 questions, or possibly 1. There's somebody raising their hand at the back.
Jonathan, I have a quick question. You mentioned on this chart, but you look at 2007, you could argue that back then the profit also looks okay. In hindsight, a lot of financial profits in the US, big part of the SPX profit was probably too high at that point. So you look at the valuation, back then it doesn't look that high for a lot of stocks that subsequently collapsed a lot. So how you compare the two? Because you mentioned that a lot of time looking at the current cycle, it doesn't look like we're peaking, but you look at like 07, there seems to be a profit bubble. So
okay.
what bearish people argue now?
That's a great question. What's the difference between 2007, when in fact things like Schiller PE or our own version of it, which is Trend PE, actually looked very similar, and you could have argued profits were above trend and people were forecasting further growth in profits. Well, I think some of my risk appetite charts tell you that. The financial system is much less leveraged. The US housing market, which is the major piece of collateral that is used in lending in the United States, is undervalued, not overvalued. Chalk and cheese, as far as I'm concerned, in terms of the starting circumstances. Even if I said no, there are other differences, but I think those two are the most important ones. I think there's a much, much more credible prospect that profits will continue to grow in the coming 2 years, and there's much less of those kinds of financial and asset price imbalances. You could argue that some areas of the tech sector are overvalued and bubbly, but not across the whole array of the financial sector, or in fact financial stocks are, if anything, undervalued rather than overvalued. Very, very different starting circumstance. Fantastic question. I think there's time for one more.
Yes.
Yep.
Yes. Hi. I was shocked this morning when I saw in the Financial Times that the Russians are building troops up on the border with Ukraine. I really was quite shocked. In terms of geopolitics, I mean, to what extent are we really going to see something go really pear-shaped? You've got China, Japan on those islands. You've got North, South Korea. You've got issues now with incremental in Russia, Ukraine. So that's the first thing. If you have what's the view you think that something's going to go crazy? And the other one is agriculture. Everyone's talking of agriculture and food being the next wave. We're looking at it. Farm prices, agricultural land. Where do you think that is in the overall equation? Thank you.
I'm not sure I can answer that second question in the time I've got left. However, on geopolitics, there are an enormous number of tectonic plates moving. The relationship between the US, China, and Russia, Iran, the Middle East, so on. Impossible to forecast in detail what's going on there. If you ask me about troops massing on the Ukrainian border, it's all part of the negotiation process. It's the message from the Russians to the Ukrainian government. Don't get too close to the West. Now, that may be very simplistic, but that's my instinctive reaction, rather than that it makes sense for them to go in. So, ladies and gentlemen, you've got a huge agenda in front of you. Good luck with the lifts. And thank you very much, and have a good conference. Thank you.